Hi there, Alan Borthwick from DUX Financial here to talk to you about asset allocation for your KiwiSaver. As always, if you found this video useful, please share it with your friends. Now before we start, the usual housekeeping stuff will be popping up now. Okay, so here we go. When you sign up for KiwiSaver, you have to choose which fund of your providers you want your money to be invested in. If you were enrolled via a default fund, this will be chosen for you. The various funds a provider has will cover the standard range of conservative to growth, and some providers have specialist funds such as cash funds, small business funds, etc. This is so that you can choose a fund that fits your desire for return and your acceptance of risk. Now, in an ideal world, we would want a very high return and no risk or volatility, but that's not a reality. So what does this actually mean? When your money is invested into your fund, it is used to buy units in that fund, which are essentially shares. The value or unit price of these units changes each day depending on the growth or loss the fund is making. You don't lose any units, just the value goes down, which reduces your overall fund value. When the unit price goes up, you buy less units for your dollar, and when it drops, you get to buy more. Volatility is how much the unit price can swing by in any given time period, usually measured over a year. A low volatility fund might have a range of +1 to 7%, and a high volatility range -15 to +20% or more. The four main asset classes your fund will invest in are cash, which is just that, money in a bank account; fixed interest, this covers term deposits and similar, either New Zealand, Australia or overseas; property, usually shares and listed property, again in New Zealand or overseas; it could be commercial or residential; and shares are just that, shares in companies across the world. On this graph, you can see where the various asset classes sit in terms of potential return versus risk or volatility. The higher the potential return, the greater the chance for volatility. The next image shows this in a real sense, showing us the volatility over 30 odd years of various assets. It may not be super clear on your screen, but $10,000 invested in 1970 in cash, which is the orange line here, would have in 2012 $410,000 worth of value. And as you can see, the line of growth was fairly stable, no huge ups and downs, a little or no fluctuation. Conversely though, up here, the green and blue lines, which are shares, they have, after the same period of time, a value between $655,000 and $1 million, depending on whether they're in worldwide, New Zealand, or Australian equities. But you can see here, they've had some years with massive drops, some huge gains. So very, very volatile over that time. Gaining huge returns in some years and losing huge in other years. This is the essence of volatility. So how does this translate to your funds? You can see here three common fund examples: a conservative, a balanced, and a growth fund. The balanced fund is a 50-50 split between fixed interest and cash and shares. The conservative fund is 75% fixed interest and cash and only 25% shares, and the growth fund is 98% shares and only 2% cash. So where should you invest? If we looked purely at the numbers, you would think it obvious to go for shares, as they have a higher return over time. But what if you need the money in the next couple of years, either buying a house or because you want to start drawing on it for retirement? You then, quite rightly, may look at a more conservative fund, so that while you give up the chance of a huge positive return for that year, you also minimize the chance of a huge drop in that year. If you're 20 and have a house, you have a lot of time to recover from a market drop, and sometimes that can actually be a good thing for you, which I'll go into in another video. But if you're 60, you don't have the same amount of time to recover. Also, you need to be comfortable. You need to sleep at night, and if you're invested too aggressively for you, that won't help. Similarly, you don't want to be in a conservative fund if you're a growth person, as it'll be boring. So there is no one right answer. But if you complete the risk attitude quiz, we can email you, and is up on our website at www.duxfinancial.co.nz. And then think about your plans for the short and long term. We can come up with something that fits you. Don't forget, you can always ask me for advice. That's one of the advantages of having me as your advisor. I'm allowed to advise on this, and I'm more than happy to help. Stay tuned for more videos from us, and don't forget to leave your feedback below. Finally, a small favour to ask. My business depends on helping as many people to get advice from KiwiSaver from me as possible, and to do that I need your help. If you know people in KiwiSaver and their advisor is not giving them this level of advice and service, or they do not even have an advisor, flick them this video and my details so I can help them as well. Thank you.